we have the key domestic macro data numbers for you released just a few minutes earlier, with retail inflation rate based on CPI moderating to 5.66% in March. This is against 6.44% earlier. The numbers will come as a relief for the Reserve Bank of India, as it will be below the central bank's upper tolerance band for the first time this calendar year. Coming to the numbers part specifically, March food inflation has come in at 4.79% compared to 5.95% in February. Housing inflation has come in at 4.96% compared to 4.83% last month. Fuel and light inflation has come in at 5.11% compared to a mammoth 9.90% in February. Inflation has been a bogey area for the government, and the central bank has been forced to repeatedly hike interest rates to rein in inflation. The RBI Governor Shaktikanta Das last week explained that the reasons behind the unexpected pause in rate hikes, all through the jury was out on that. We have with us Srinath Sridharan and Karan Mehrishi to help us sort of read the latest macro data. Let me start with you, Sridhar. The numbers have come in, and finally there is some relief, and it seems that the rate hikes that the RBI had been doing are now coming into effect, and the pause seems to have been worth it. What are your initial thoughts?
The rate hikes definitely seem to work, at least for this month. Let's hang in there with the summer sweltering heat hitting there. The oil prices globally is still a challenge, right? We are okay as long as the crude prices are below $85 to a barrel. If it starts inching upwards, then all these inflation numbers could go for a hike. Food inflation still is a kind of a worry for me, because if you notice, there's another macro view that the IMD, the weather department, gave out saying monsoon will be normal. Whereas SkyMet, which is the private forecaster, said the monsoons would be 2/3 of the usual. That's a concern, because going forward the next couple of months, they will have a bearing on inflation. Today, I think RBI's governor must be feeling very vindicated with his decision for the rate decision last week. But I wouldn't write it off saying I wouldn't start cheering yet.
Okay. Karan, let me bounce it off you and take it from where Srinath had left it. 4.79% compared to 5.95% specifically on food inflation. And of course, the forecast that came, contradictory forecast between IMD and SkyMet. So, with monsoon coming and perhaps the likelihood of El Nino, are you bullish on this number to stay within the band, or likely to go higher as the months progress?
Well, to Kartik, start with the food inflation. It's very important to understand that the food category has a weight of around 46% in the overall CPI basket.
Yeah.
And any elevations here have a significant impact on the overall inflation number. Consequently, I think despite a glut in the vegetable supply, which is around 9.6% weight in the overall basket, food inflation recording an over 6% inflation for much of FY23. And has been a cause of concern, especially given the fact that staples such as wheat and rice, which come under the cereals category, are recording inflation of upwards of 15%.
Right.
The milk and dairy categories, on the other hand, is also a category of worry in the food basket, which has remained elevated. My sense is that rising discretionary income of Indian households will allow them access to protein items, and supply must be augmented to meet rising demand. A similar story is emanating from the personal care items, showcasing very healthy demand for discretionary goods. This is pretty much in line with the healthy growth that has been recorded by the non-durable category in the IIP. Fuel basket, on the other hand, remains elevated despite rising Russian imports. This is happening because of, again, excise on retail fuel, which is not allowing benefits to reach households. Overall, I think from the inflation numbers, we can decipher that India's consumption story is intact. And rising disposable incomes is putting pressure on prices of consumables. So I see this as a simple demand-supply mismatch. I do not see any structural problems here. Coming to the El Nino, I think it's a significant risk for the economy. As the other panelists were suggesting, SkyMet has predicted the LPA at 10% efficiency. What this means is that central and western India may receive less than optimal rainfall, impacting the Kharif season significantly for FY24. So it is possible that food inflation may be stoked further in FY24 as well. And given the weight of the food category, as I was mentioning, this may put upward pressure on the headline number as well.
Okay, so Karan, this sort of weightage that is allocated to the food basket, is this inclusive of dairy, inclusive of milk, or exclusive of milk?
Absolutely. Yes, Kartik.
Okay, so milk inflation doesn't seem to be ebbing at all. In fact, even if food inflation has come down, the real challenge in pricing, in rising prices of milk and milk products still continues to be a concern. So, how does the central bank or any other fiscal measure contain milk inflation?
This is a simple supply-demand mismatch, Kartik. So I don't think a central bank can do anything about it. So it's all about augmenting capacities to meet the demand and the fact that Indian households now have discretionary consumption power. I think this is pretty much in line with how a country evolves economically, and households become they sort of demand more protein-based items, including dairy,
Right.
and it's a normal course of evolution of an economy.
Okay. Srinath, let me come to you. Now, let's talk specifically about fuel and light inflation. And fuel inflation, of course, we are yet to see the real impact of OPEC Plus sort of, cutting down its oil production and the kind of price stabilization, as they call it, but price rise, as we understand. That's yet to sort of hit us and hit the global market as well. So right now, we are seeing that fuel inflation has come down to 5.11% compared to 9.9% in February. But once this price stabilization in the fuel market happens, what should we look at, especially with the summer months approaching, where consumption of power is going to be much higher?
See, that concerns will continue because the pricing, the actual bill we will end up with a new revised bill probably 2 months from now as we do more offtake of crude oil. Two, also our summer months going forward, if the monsoons are delayed, we are going to see a surge in power consumption to the pricing mix for power. I mean, end of the day, we still are dependent largely on fossil fuels. That is going to increase. And I want to link this to also the dairy category that we spoke about, right? I mean, it's interesting to see the last 3-4 years of data on ice creams, chocolates, the dairy products. Despite glutton dairy production, a lot of these get diverted into high value goods in the form of ice creams and other products. Will that continue? Looks like it will continue, which is why we are also seeing out in a kind of a sense the Amul's entry into Karnataka, forgetting the political optics around it. It's also a great market opportunity for somebody who's saying, I have excess supply across my supply chain. I would rather turn it into a high value product in Karnataka. So I think some of those are going to be challenging. Coming back to your OPEC question, we wouldn't see the increased bill until May end or June. So in that way, we are still fine. But our consumption, if you look at the patterns or conversations with travel industry and airline industry, the summer months seem to be going extremely full for them, which is good for them from revenue point of view. But they're all going to burn fuel. All hotels are going to be sold out across the country, which is great for the economy. But at some point, it's going to mean a lot of fuel consumption.
Okay, and data just coming in from the US as well, and CPI in US for the month of March rose by 5% year on year, and this is compared to 6% the month of February. So there is better news even in the US, and CPI in the US has also dropped by a good 1 percentage point. So how does one read into that? Do we expect that even the US Fed is now finally going to get rid of its hawkish stance and pause rate hikes in the next FOMC?
So I think US has a far more structural difficulty than us. The last 10, 15 years of cheap money, ever since the global financial crisis, they've been having the cheap money concept. And in the last 12 months, they've increased the rate so drastically that they just can't overnight turn the wheel. We have had one huge bank get followed by another bank. So US, I wouldn't worry. Structurally, they have long way to go, and they have deeper pockets as well. The bigger concern the US will have is they just keep printing currency. I'm so glad that we don't retort to such quick short-term measures. RBI is far more conservative and prudent, and which is what has kept us safe so far.
Okay. Karan, let me come to you with the same question. What do you expect in the next FOMC with inflation easing a little in the US as well? Though, 5% is still a high number given the growth rate that US sees as compared to a 5.66% versus, let's say, a 6.5% GDP growth. So, what do you make of FOMC's decision on pausing rate hikes? Perhaps for the first time, they will take that action after the Central Bank of India, RBI, has taken a pause.
Well, it's too, Kartik, it's too early, I think, to celebrate right now. And that goes both for the US and the India economies. So Governor Powell reiterated the importance of managing price levels for the overall stability of the macroeconomy. And high inflation means that purchasing power of households is impacted significantly. And that's, I think, the primary concern for the FOMC as well. Now, in order to understand the dilemma the US Fed faces at this time, we have to look at the Fed's Philip curve, which is basically targets inflation rate of 2% with an unemployment level of around 4%. Now, given the fact that unemployment level is hovering at around 3.5, 3.7%, there is no way inflation of 2% target can be achieved anytime soon. And now that the IMF is suggesting that the US economy, which is worth $2.25 trillion, would be growing in real terms by 1.4, 1.5%, I think the unemployment rate would come down even further. So I think there's definitely prolonged or tighter monetary stance by the Fed, and I think they're just waiting and watching right now, just as the RBI.
Okay. Karan, stay with me and help me make sense of the numbers which are coming on the industrial output as well. So, industrial output has risen 5.6% in February, and this is a good growth of about 1.2%. So, what is driving industrial output in India? What drove it for the month of March?
Well, I think,
for the month of February.
We have to look at the overall picture here. I think the IIP print is closely associated and is following the capex cycle, and you see growth in electricity and mining from a sectoral perspective. Also, from the use-based perspective, you see capital goods and infrastructure goods recording a very healthy number. So I think the IIP story will be driven largely by the infrastructure push of India and the persistent public capex. I also think that an overall 5 to 6% IIP growth rate can be considered a very healthy number under the current circumstances. So I think I have no concerns regarding the IIP number as it is being recorded.
Okay. Srinath, what could hit industrial output? Right now, the numbers are looking good and we are seeing a growth trajectory on industrial output. Any risks that you foresee which could hamper this growth curve that we have started climbing?
Domestic consumption monsoon is definitely a worry to watch out for, and globally in terms of pricing margins and some of the key markets like US, UK, which are large importers, if they slow down, then we have a great challenge.
Okay. And any risks that you foresee, let's say with the situation, the posturing that China is doing in Taiwan Strait right now, if things were to go south between China and Taiwan, what kind of an impact do you foresee on India's manufacturing output?
See, I don't think it could go any southern than already the south it is. For years, I mean, China has been flexing its muscle, and I also anticipate it will continue. Will they go into a actual war-like zone like what, let's say, Russia-Ukraine has seen? Doubtful. But otherwise, China has been needling almost every neighbor, including us. So I wouldn't play much heed to it.
Okay. And the fuel prices, as they stabilize or rise, especially in the OPEC plus region, the production from there is going to hit US much sooner than it hits India, because India is still sort of cushioned with the Russian oil that we are importing right now at a cheaper price. So so how is that going to play out for US inflation and thereby the rate hikes that may continue in the US, and eventually how does that trickle down to India?
See, I think on the jocular side, we all expected a late Christmas for the US, saying that at least the first quarter end, they will have a better Christmas in terms of consumption jumping back. Doesn't seem to have happened, and which is also reflected in, if you look at the stories, today's TCS story on their US business, and tomorrow Wipro is also coming up. some of those concerns will continue. US will bounce back because end of the day, I think they're very clear that they need a lot of countries, including OPEC oil, to keep them running. And I think that is where their lot of their foreign policies today tilted towards. So I don't see a change in US. They may not go through any short-term difficulty due to OPEC oil.